Joining us now is Investment Solutions Chief Investment Officer Glenn Silverman. Thank you very much for your time.
Thanks,
well, there's no stopping the market. I mean, we hit a new record close on the JSE All Share today. The momentum seems to be more and more positive. And of course, towards the end of last year, we were debating extensively with the like of a Paul Hansen, who took on the bull side of things, as we know Paul often does. And Glenn, you were the bear in the discussion. Where do you stand at this point?
So we've just had a December period. We had 4 weeks away at the coast to kind of reflect and really give a lot of thought to whatever. And I've given a lot of thought to it, and I probably ended up more bearish than I was before I started.
Even more bearish?
Even more bearish.
Where did you go on holiday?
That's the point. Beautiful weather, but I think global warming was to account for most of it. But I'm not even being facetious when I make a remark like that. I think that the word that I've come back for this year, and that's all I'm going to focus on, is sustainability. I think anything that is not sustainable won't be sustained. I mean, John Morden makes that point, and I think he makes it very, very strongly. So we're going to look for sustainability in everything, in our managers, in the environment, etc. And I see much that's unsustainable. In fact, most.
And I'm assuming that's also pertains to the international environment, that you don't see that sustainability in the Eurozone, perhaps even the US?
So I think that's exactly what we're talking about. I see it broader than that. I mean, we start with the globe itself, and global warming is an issue to me because we've got a finite planet that we are exploiting at a level that we know it can't continue. At some point in time, 7 billion or 10 billion or 20 billion people just cannot keep using a finite resource. It's got to come to the fore and be taken into account in terms of people who are thinking on a longer term perspective. Demographics are playing out in a way that I think are interesting. Corporate profit margins, these are fantastic results coming through. These are really good. Are they sustainable? I doubt it. I really struggle to see it. And then debt. We don't have to talk about debt, but everyone's still focused on Europe. And we say, world, Europe, what about Japan, which is insolvent? What about America? That's not many years from that. So I'm taking a 3 to 5 year view. And I'm saying, guys, if it's not sustainable, it probably won't be sustained. What would be the rating, the P multiple you might put onto something like that? And I'm coming up with numbers that I think are lower than we are now.
Wayne, this is not music to your ears.
No. Look, I mean, I'm not a massive bull at all. Because I understand the only reason
why... But you do lean to the more positive side. Let's be honest about this.
I mean, I hope one day that when I do eventually retire, that I'm not just known as a bull, that I do get bearish now and again. I try and
be, balance there.
I try and be a little bit realistic. Look, the big reason why the market's doubled in the last 3 years is it fell 50% before it doubled. Okay, so the big recovery in the share market is over and finished. We are not about to embark on a brand new bull market fueled by world growth, simply because the world's not going to grow massively. I mean, I don't think it's going to grow at 0.5%, but if you're lucky, maybe it grows 1.5%, 2 odd percent over the next year. The US is debt pool. Europe is a debt pool. But to me, the implication of that is sustained lower growth for decades. It's not a collapse.
All right,
I mean, that's just that's my view.
Let's take your view
lower growth
and harness the lack of sustainability that you see across the board. What are you looking for then when it comes to managing money? Because you are chatting to managers right now.
Yeah. I mean, the starting point is, I'm saying to my manager research team, start to see which managers are taking this type of long-term strategic thinking into account. Which managers are focusing on sustainability. And I think all good corporates should be doing exactly that, and I think they are doing that. So I'm not disagreeing with Wayne here. I think we are talking about a slower growth environment, not a collapse in growth, but that could come still. And that may just be, kind of where we end up going. So we're going to watch this. We're going to have to stay close. But I think to end up looking at the world and saying markets are very cheap, and they do appear to be cheap, I'm debating that.
They're not cheap, no.
And they're not particularly cheap. And I think we've got earnings which are high, and therefore high earnings probably demands a lower PE. So we have a phase where, and we've come back now and look at the commentators. The commentators are actually saying most of them are actually bullish, if I read what they're saying. And the reason they're saying is because everyone's bearish. And I think there probably is too much pessimism in the series, kind of out there. And so I think we're going to get volatility, we're going to have these rallies, and then we're going to give it back. But a sustainable bull market, I'm in Wayne's camp. It's unlikely, but rallies of whatever, 10 or 20%, yes, but probably give it back. So, if you end up a year or 2 or 3 later at the same position where we started, I don't think that's great.
With this more bearish view, I still want to drill down into what asset classes you fancy.
And I think we've discussed it before, and I think you have to have a balance. I really do. I think to make a very bold call one way or another just doesn't make sense to me. Everyone hates cash. So on a contrarian basis, probably have to have a bit of cash there. I think it's actually a very important asset class. I really believe so. Everyone hates gilts. I mean, especially globally, they just think this is a terrible place to be, and yet have actually done quite well. And then we have the debate about deflation, inflation. I think gold is an important part of a portfolio. I think property is very important. It's a hard asset. I think you've got to have some property, and then you do have some equity. So I'm talking again, a nice
fully diversified across
very
the
diversified portfolio
spectrum.
With some asset allocation.
Yeah, look, when you look at our structure of our portfolios, there's only one statement we're really making, is we're very underweight global developed market bonds. Because to us a 2% yield is just not enough to justify the investment. But otherwise we, in fact, slightly overweight property, we've got a bit of direct gold in the portfolio, and we're neutral on shares. So, I think it's broadly reflective. Other than global bonds, I don't see why you want to place your portfolios in a big position, positive or negative. But I promise you, the share market, let's just say the share market goes up 15% in the next 6 months, we'll be sellers.
When you say cash, looking at currencies right now, what is your outlook?
So I would probably still have a preference of staying away from the euro and towards the US dollar. It's an amazing thing. We have risk on and risk off, and it's going to happen. The moment there's risk on, gold goes up, equities go up, dollar goes down, rand strengthens. I mean, it just happens for one quarter, this and the other. If you can tell me risk on or risk off, I'll tell you exactly what's going to happen. I'm trying to look beyond that and say, are we likely to end up higher or lower? So I wouldn't differ too much with what Wayne said. In the short term, I still think I think there's inflation. We've discussed this before. We have both inflation and deflation in the system simultaneously. At product level, I think there's a lot of inflation globally, not just in South Africa, but at financial market type of level, I think it's a deflation environment. But long term, there's no value in those developed market bonds. I can't argue with Wayne at all. At some point in time, whilst I think you're going to get some return from them, long term, it's a problem. We need to talk about returns more.
This low yield environment.
It's a low yield environment. It is.
I mean, if you think about it, with the amount of money in circulation, and there's tons of free money overseas, there's tons of liquidity, can we sustain inflation below 1% over time? On a 5-year basis, to me, it's inconceivable. So if inflation's 2% and you're buying bonds at 2%, there's no reward for risk. So I actually think global inflation-linked bonds are a fantastic asset class to hold. Maybe even local inflation-linked bonds, although I'm not too worried about SA domestic inflation, because we're going to get some relief from food now. The rand unlikely to collapse, and eventually the Eskom, we hope the Eskom increases stop. The 20% and 40% increases stop. So I'm not too negative. Maybe SA inflation-linked bonds is also a fair investment.
Coming back to this low yield environment, do you think that investors, particularly South African investors, are going to get their heads around the fact that this is the reality going forward, and that it's probably now more about capital preservation than it is about shooting the lights out in any asset class?
I made the point before, and I stick with it. I think South Africans are still better off than other places. There, the yields are terrible. We're talking internationally, cash is broadly zero, and Wayne mentioned developed market bonds at 2 or 3%. And we've had a discussion about gold and commodities, could go up, could go down. So it's all in equities' hands. I think equities, if they give you 15% and hold that for the whole year, you get a reasonable year. Without that, you don't get much. South Africa, I still think we've got reasonable yields. Obviously, inflation, I think, is more of an issue than Wayne alludes to. You may not be getting much of a real return on both cash and on bonds. But the normal returns aren't bad, and even when the returns maybe inflation's under some kind of control, you're probably still okay. So I don't think we need to say to South African investors, where typically 75% of the money is, especially in institutional space, sits, it's going to be terrible, but it's lower.
It's going to be reasonable, lower.
A lot lower than the 10 years we've seen to date.
Yeah. I mean, and Glenn makes an important point on all of this. If you take a South African share market from 2003 to date, including the financial collapse and the credit bubble and the whole lot, the returns are phenomenally higher. I mean, the market's up 350 odd percent. Maybe if you compound dividends, maybe it's close to 400%. I mean, it's highly unusual. It's very, very high equity market returns. So we've got to be realistic and see lower equity market returns. But the one thing in our favor is we're not starting this year, as we did a couple of years ago, at an 18 PE. We're starting at a 13. So the risk of a collapse is just less than
and that's what I wanted to throw to you, the risk of a collapse, worst case scenario. What percentage would you put to that?
The amount that the markets could fall?
Well, effectively looking at a global financial crisis 2 scenario. Let's talk about a collapse of that magnitude across the globe.
See, I think we need to recognize that those risks are very, very high. They remain very strong. I think they're actually going to build up again today, tomorrow, next year, I'm not sure. But we want to invest money here on a 3 to 5 year basis, and I'm thinking there's a lot of risk there. So if they were to fall, why not 50? Why not 50 when they decide to fall? I don't know if it's the first half of this year, could be the second. There are a lot of things to play out here. I mean, I think, everyone has said, Greece, I think, is tired and whatever, and we've spoken before, and they've just thrown the Greeks out a hell of a long time ago when having the debate, etc. But there's debt across the entire, even Germany, which is the best position, it still has a high level of debt, and debt accumulates over time. We need to see growth levels in Europe higher than the interest rates that they're paying, and that's going to be kind of a challenge. And America, no one's focusing on again, but does come back to the fore. We're going to see some fiscal drag, actually quite significant fiscal drag this year. They're going to have to cut back. We've got an election year, so maybe they try to get through this year again. Certainly Obama will try for that. What about 2013 then? So I'm not forecasting something. I'm just saying if things aren't sustainable and the problems are not resolved, you've always got the risk out there.